This is Bloomberg Markets Today. I'm Anna Edwards, live in London with Tom Mackenzie. Mark Cudmore, our Markets Live managing editor, joins us from Singapore to take us through the market action this hour.
The cash trade then just less than an hour away. Here are your top headlines. Holding steady. Asian stocks and futures climb after Jerome Powell hints the Fed may be finished with its most aggressive tightening cycle in 4 decades. Following the Fed, investors also expect the BOE to hold rates as evidence mounts that the UK economy, labour market and inflation are all weakening. Plus, Novo Nordisk profit tops forecasts as sales of its obesity and diabetes drugs surge. We speak to the CFO and CEO later today.
That'll be an interesting conversation. Welcome to Markets Today. It's just gone 7 a.m. here in London. Mark is with us from Singapore, of course. Mark, what are the markets saying to you?
Good morning, Anna. Good morning, Tom. Well, risk assets are rallying right across the board since the US time yesterday. We're seeing dollar softer, we're seeing global yields lower, and we're seeing risk assets higher. I should say those gains are already running out of steam, and they are starting for the wrong reasons. Yes, we saw much lower US yields, but it was not because the Fed was particularly dovish. It was actually because we got a very, very disappointing ISM, and the massively overhyped Treasury refunding announcement didn't shock as much as people feared. So we're seeing lower yields, but for not brilliant reasons. And that's why happier risk assets are already starting to pare their gains a little bit.
And I was going to say it's all about the Fed, clearly also about the data. Let's get to some breaking news here in London then, Mark, and it comes from corporate earnings, of course. Numbers through from Shell just a couple of days after we heard from BP. The adjusted profit for the third quarter at Shell is exactly in line with estimates, $6.22 billion US dollars. What is not quite in line and what seems to be higher than had been anticipated by some analysts is the buyback. They've announced a share buyback program of $3.5 billion. I'd seen some estimates of $3 billion, so that might go down well with some investors. Always a focus on debt here, and we see the debt number, the net debt number for the third quarter coming in below estimates as well. So things seem to be either meeting or beating expectations when it comes to Shell. BP, of course, was weak in its gas trading part of the business, so we'll look for any updates on how the trading side is doing at Shell. And also a focus on M&A within the broader sector, of course. Deals by Exxon and Chevron certainly putting putting that theme fairly front and centre when it comes to energy majors. Tom, what do you see on the futures?
It's really interesting, isn't it? It does seem like there's a divergence, as you say, between the numbers that they've got from BP and what we're getting from Shell. And the buyback of BP, just $1.5 billion versus that $3.5 billion coming through from Shell. That's really interesting in terms of the split that we seem to be seeing. Across your futures, you're looking to potentially get to a 4th straight day of gains. There is this relief coming through, of course, in terms of the expectations from at least some in the markets that you are now fully in pause territory from the Federal Reserve. The question for some is, will they go to the next step being a cut? The Bank of England, of course, today, so we think about how that works into UK markets. Across the futures then, the European futures looking to gains of 0.7%. FTSE 100 futures looking to add about 44 points. Over in Germany, the DAX pointing up by around 94 points. The tech rally as well came through yesterday on the back of those lower yields. The 10-year yield dropping by, 20 basis points. Let's have a look at US futures then, looking to build on the gains of yesterday. S&P futures pointing up by 9 points. NASDAQ futures looking to add around 0.4%. Mark, what is standing out to you on the GMM this morning?
Well, Tom, you mentioned the 20 basis point move in 10-year Treasury yields, and that's really the big factor here. There are 3 reasons behind that. There is the Treasury refunding announcement, which many people were hyping up would cause fiscal concerns and therefore cause yields to go higher. It didn't. It came in slightly below expectations, and there was relief there. There was also word the Fed might be very hawkish in their hold. They were slightly hawkish again. That was another risk averted. Both those reasons meant yields lower, but they also meant, because we moved those 2 big risks, that we could focus on the fresh data we got yesterday, which is appalling ISM data. So all 3 factors helped 10-year yields now trading about 20 basis points lower than where they closed on Tuesday. And because of that, we're seeing yields right across the board move much lower today. And that's the main driver of what we're getting. Because of that, we're seeing dollar weakness. We're seeing currencies right across Asia gain. We are seeing equities gain as well. Note China is down, though. A little bit of disappointment. It's been pairing gains all day. Like most of these markets, actually, again, they started very strongly, but been pairing gains all day, kind of slowly. In commodities, we're seeing higher, which makes sense. Softer dollar, lower yields. That makes sense for higher commodities. But note, oil prices are also higher, and that might start being a concern if that's another leg up towards the highs of oil prices.
OK, Mark, let's talk about the markets in 3 minutes. And you've made it clear that what we're seeing in yields and the dollar and a lot of assets is not all about the Fed. It's also about the weakness of the data. And that US ISM manufacturing number coming in with a 46 handle, much weaker than had been anticipated, clearly in contraction territory. What exactly does that mean for the Fed, though? Does that mean that people are bringing forward expectations of when we get a cut? Does it mean that we are on pause sooner? How does that translate into our market interest rate expectations?
So the market is pretty convinced we've got a pause. We did run a pulse survey straight after the Fed last night, and in fact, 51% versus 49% of Bloomberg terminal users thought that we'd actually have another hike ahead of us at some point. But it's obviously very much in the balance. Now, market pricing does kind of say there's potential, there's a risk for another hike, but it's not the base case out there. It is the idea that we're at the peak of the cycle. And I think that, you talk about the ISM data. Look, ISM used to be a great, manufacturing in particular, used to be a great lead indicator for the recession. US. It's lost that ability, and part of the reason is that the soft data out of the US has not been a great guide in recent years in either direction of the cycle. It's very, very hard to ascertain one particular reason for that, but generally the hard data has not followed it in the way that it has in the past. So I wouldn't want to put too much weight in that. But the ISM component that was very weak was the employment index, and obviously we had ADP that was weak yesterday as well. So that both them are giving warning signs for the NFP on Friday, which, as we've talked about earlier on this week, is probably the really big US event risk this week, because we got too overhyped about the Treasury refunding announcement.
Yes, I was going to ask you about jobs, because there are a number of jobs indicators you can look to get a sense of what Friday might bring, what tomorrow might bring on the NFP fronts in the US, from ADP to JOLTS to jobless claims. What are you looking at this stage of this cycle for the clearest clues?
Yeah, so the best indicator for the turning point in the cycle is initial claims, and it's saying nothing yet, and I think that's really, really relevant. The second best is non-farm payrolls. The worst is JOLTS. JOLTS is a big picture number, but we get much more lagging indicator, so it doesn't matter that we got a strong JOLTS print for September. We already knew that from the NFP print a month ago, so we knew September was strong data. We knew the economy was strong then. So at turning points, JOLTS is useless. Unemployment rate, also a lagging indicator. So the best ones are initial claims and NFP. There's been no sign in initial claims yet, but I would say that some of the data we're getting from ADP and ISM employment suggests that there's maybe perhaps slight downside for the NFP print on Friday, but it seems like jobs market is not yet crumbling. I should remind everyone the jobs market is a lagging indicator of recession, but you'd expect initial claims to be showing a little bit more nervousness yet if we're going to be going into recession around the end of the year, as I think.
Yeah, OK. And we're back to earnings stories as well, having an impact. Certainly the tech sector responding to AMD's results.
Yeah. AMD, Qualcomm, those earnings as a result provided a little bit of relief for AI and tech. And I guess that kind of helped the general good mood out there. I think that we can see a good mood overall sustained for the next week. But of course, as I've emphasised, NFP is going to decide so much around the sentiment for the next week.
OK, a lot to watch there then on earnings. Remember, you can get up-to-date analysis and insight from Mark and the rest of the Markets Live team. MLIV Go is the function to use on the Bloomberg terminal. Coming up then, Novo Nordisk's results beat estimates as demand surges for its obesity and diabetes drugs. We'll dig deeper into those numbers from Europe's most valuable company. Plus, we're live from the Barclays Asia Forum in Singapore with the former chairman and CEO of IBM to discuss the opportunities and risks, of course, with AI. If you have any questions for our guests, please do get in touch. IB plus TV Go is the function to use on the Bloomberg terminal if you want to get in touch with the team that puts together this programme. And for the Markets Today blog, go to the front page of the Bloomberg UK website, click through from there, or you can type TLIV Go on the Bloomberg terminal. This is Bloomberg.
We've come very far with this rate hiking cycle, very far. Given how far we've come, along with the uncertainties and risks we face, the committee is proceeding carefully. It takes time, we know that, and you can't rush it. Slowing down is giving us, I think, a better sense of how much more we need to do if we need to do more. We're going meeting by meeting. We're asking ourselves whether we've achieved a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. We haven't made any decisions about future meetings. We're not confident that we have. And that is the way we're going to be going into these future meetings. The progress is probably going to come in lumps and be bumpy, but we're making progress.
Fed Chair Jerome Powell there speaking after the FOM's rates decision, of course, holding rates for the second time. And the investor view, at least across these markets, seems to be that this is a Fed more firmly in pause territory. He hinted at the prospect of maybe being done in terms of the rate hike cycle. And, of course, the statement included a focus on the tightening, the financial conditions tightening that's come through as a result of higher yields. Let's get more analysis then on this decision by the Fed and the comments we heard from the Fed chair, and bring in Kim Crawford, Global Rates Portfolio Manager at JPMorgan Asset Management. Kim, your take on what we heard then from the Fed. Is this now a Fed that is solidly in pause territory? Is the next move from the Fed a cut?
Yes, we think that the Fed is most probably done now. So they gave us the similar data dependence message, but I think it did tweak a bit dovish. And they could have talked about the recent strength in the payroll number, reference it to the previous few months, but instead they referenced it to the start of the year. So they're still viewing it as overall moderating. And then, of course, the important part is that they explicitly reference tightening in financial conditions. And we'd be surprised if that didn't show up in the data in a few months' time. So for now, you're seeing outperformance in growth and labour market data. But for us, the soft patches are building as well. So delinquency rates are rising, and we know that incomes are going to be falling from here. We saw the ISM manufacturing print yesterday, general demand and also supply for credits weakening, and then financial conditions tightening.
OK, Mark.
Kim, good morning. So you've kind of talked about there some of the weakening data coming through. On your base case now, when do you think the US might go into recession? And in that context, how accurate do you think current markets rates pricing is at the front end?
At this point in the cycle, it's always difficult to pinpoint the exact month. But for us, we're thinking about Q2, middle of the year, where you could really see that economic data rolling over once the tightening in financial conditions and also the general lags in monetary policy have fed through.
OK, and let me ask you a bit more about that, because you say that we're seeing a reduction in demand and supply for credit. You say that we're going to see the effects of tighter financial conditions showing up in the months ahead. So that's sort of Q2, the answer there. What are we seeing on the credit side then? Because I spoke to a guest yesterday who was saying, actually, there's not so much refinancing demand, in particular at the high end next year. It's really 2025. So I wonder how long we limp along for, or whether things really come to some sort of crunch.
Yeah, no, the wall of refinancing is definitely more in 2025. That's still to come, but that's 2025. I think what we're more concerned about is just the demand and the supply right now. So if you're having less loans being issued, less credit being borrowed, then that's just going to slow the economy over time.
We have the BOE, of course, that decision coming through later today. The expectation is there'll be a pause from the Bank of England as well, another pause, another hold. What is your view? You say you're concerned about the data that's coming through from the UK, and at the beginning of this year, they've been surprised at the resilience of the UK economy. That's starting to fray now.
Yeah, so we do think that they are going to hold today, give that tightening bias. I don't think the data set's really changed enough for them to warrant a changing in their stance. So the 5 members that voted for a pause the last meeting, they should still be doing the same at this meeting. I think the part about the UK data that makes me nervous is, on the one hand, we've got that weak activity data. We can't dispute that. It's weaker than the US. Consumer confidence is falling. The housing market is still weakening. And we've still got about half of the policy rate hikes that have already been delivered still to hit the economy. But on the other hand, you've still got that weakness in activity data not really as obviously feeding through to price and wage setting behaviour like it is in the US. So I think for now, yes, the economy's weak, but we just don't know yet how weak, unfortunately, it's going to need to be to bring UK sticky inflation back to that 2% target.
Does that mean, Kim, that 2024 will be the year of stagflation, particularly in the UK? Or do you think at some point that weak growth data will see inflation come down quite rapidly, just maybe a little bit belatedly?
I think it's maybe more belatedly. So I personally can't rule out the bank having to maybe hike again at the start of next year. If the labour market stops loosening from here, if the growth data starts stagnating, I don't think that's going to be enough to pull inflation back to the 2% target. But like you said, those lagged monetary policy effects, they will come through. And I think when they hit the UK economy, they will hit them the hardest and the most rapidly compared to the other developed markets.
Yes, and comparing the Bank of England with other central banks, we've got a guest coming up in the next hour who says in his notes that the Bank of England is more inflation tolerant than other central banks. How do you view tolerance of inflation around the globe?
I think what the Bank of England's going to do now is they've been scarred by inflation persistence and being slightly behind the curve, possibly. So they're going to really look at the whites of the eyes in inflation before they cut. But I think that's similar globally as well. The Fed's going to do the same. I think the ECB is probably in the best spot at the moment, or the easiest spot. So you've got really clear signs that monetary policy feed through is hitting the economy. And you've got growth and inflation both moving in tandem, weakening. I think if you look at the 3-month annualized rate of core inflation, that's already below 3%. So I think they are currently in the best spot to maybe start cutting.
All of this takes you to a positive view on bonds. Which regions? What are your top picks?
And for us right now in global bond portfolios, it's the UK and Europe. So Europe because it's the clearest picture of lower inflation, lower growth. We do like the UK on valuations. I think it has one of the weakest economies right now. Inflation has turned that corner, although it might prove sticky next year. But it's also the only developed market economy that actually has signs that the labour market might be cracking. So we've got positive real yields, a labour market that could be cracking. We see clear strategic value in owning some UK government bonds as well.
Can I pin you down to exactly what maturity, in context that I know you see downside growth coming through and you basically, there's the most price still in hikes in the Bank of England, but you have said you don't think any central bank will be rushing to cut rates. They'll want to wait to see the whites of inflation's eyes. So what part of the curve exactly do you want to own in the UK?
For now, we really like the long end of the curve. I know a lot of people are worried about the long end of the UK, given the issuance dynamics that we've had and just the change in the structural demand for the long end. But I think there are tailwinds right now. I think buyout activity could slow into the end of the year. I think we are seeing demand come in at that 5% level. It's looking attractive for international investors. And you are more protected in case the Bank of England does need to give us a hike or two next year.
Kim, thanks so much. Thanks for joining us this morning. Kim Crawford, Global Rates Portfolio Manager at JPMorgan Asset Management. Let's get to some of the other top red stories on the Bloomberg terminal this morning. Qualcomm has given a better than expected revenue forecast for the current quarter, indicating that the mobile phone industry's inventory glut may finally be receding. The sales estimate from the largest seller of smartphone chips sent shares higher in late trading on hope that consumers are finally beginning to upgrade their phones again. Disney says it expects to pay at least $8.61 billion to buy Comcast's one-third stake in the Hulu streaming service. The statement marks the start of negotiations expected to last months. The companies have previously said the final price will be settled through an appraisal process and is likely to involve up to 3 investment banks. A former Goldman Sachs investment banker has been sentenced to 3 years in prison after passing confidential deal information to his squash partner who traded on it. He was found guilty of insider trading and obstruction by a federal jury in June. Bloomberg has learned that JPMorgan is searching for potential partners to grow its business, its private credit business. Our sources say the bank's in talks with sovereign wealth funds, pension funds and alternative asset managers. JPMorgan is looking for third-party capital to supplement more than $10 billion already set aside for its private credit push. Tom, what is the subject of your morning must-read?
Well, I bring it to Geopolitics and a really interesting column by Bobby Ghosh from Bloomberg Opinion. Look, this is an opinion piece, so bear that in mind. But it's about the geopolitics. It's about, of course, the Israel-Hamas conflict and how that's unfolding. And for the markets, arguably, the big focus is, does this conflict spread because of the implications of that? And when you think about spreading to other areas, then Hezbollah, based in Lebanon and backed by the Iranian regime, is front and centre. And what Bobby Ghosh is outlining is his view that actually you've seen relative restraint from this group that, again, is backed by Tehran. And he doesn't think, he's arguing that Hezbollah is not ultimately going to come in a big way and take on Israel and their military. He says Hezbollah's restraint suggests its patrons in Tehran, for all their threats of a wider war against Israel, and we have heard those threats, are reluctant to commit their most valuable asset to the conflict. And he outlines a couple of reasons why. One is the central role that Hezbollah plays in Lebanon in supporting the Shiite community. He says that Iran wouldn't want to see that degraded. Number two is in terms of its support for the regime in Syria. And number three is continuing to pose what he describes as that menacing threat to Israel. So for those three reasons, Bobby Ghosh is arguing that Iran will not want to see Hezbollah degraded, as they would be inevitably, he says, in any conflict with Israel. And for that reason, he thinks they're not going to be drawn into this conflict. That is consequential, of course, for these markets, as, of course, we continue to focus on the human toll of this conflict, Anna.
OK, absolutely. Certainly worth a read on the Bloomberg terminal. Let's get more details then on the latest state of play in the Middle East. US President Joe Biden says Israel and Hamas militants should pause fighting in order to allow time to free hostages held in Gaza, but he stopped short of supporting a full ceasefire. It comes after Egypt opened its Rafah crossing with Gaza yesterday, allowing an initial group of people to flee the fighting. Let's get more with Bloomberg's Oliver Crook in Tel Aviv. Oliver, what are the latest developments then?
Yeah, let's start there with the Rafah border. So that meaningful development yesterday, we had two categories of people that were allowed to leave Gaza and go into Egypt. The first were the wounded Egyptian ambulances carrying some Palestinians out who had been hurt during the fighting and during the bombardments. They're being treated in a field hospital in the northern Sinai. But the second are the foreigners that are now being permitted to cross over. And we have the list today from the Hamas crossing guard of 596 people who will be permitted to leave Gaza today, 400 of whom are American citizens. We've heard from the U.S. that there are about 1,000 Americans there right now. This as the fighting in the north of Gaza intensifies. We understand from the IDF that the military forces of the Israelis have reached the sort of city gates of Gaza City. And it comes as Blinken and his team arrive in the region tomorrow. They will come to Tel Aviv. They will come to Israel. They will also go to Jordan in a diplomatic effort that is really only made more complicated in the last sort of 3 weeks, because what has happened since he was last here? Well, for one, we're some distance further away from the attacks of October 2nd. And according to the UN, you have now more than 8,800 Gazans that have been killed in all of the bombardments and the fighting, 2/3 of which are women. And again, we're seeing more outcry and more objections around the world, perhaps driven home by a significant development yesterday with the Jordanians pulling their ambassador to Israel from Israel. And remember, Jordan, one of the first countries in the region to make peace with Israel in the 1990s. This as Netanyahu has said he's going to continue to pursue the military victory against Hamas. So perhaps if they're not willing to dial back, the Israelis, that is, on the military front, it puts a bit more urgency on the pressures of this potential humanitarian pause, or at least finding other ways to get more aid into Gaza.
OK, Bloomberg's Oliver Crook on the ground for us in Tel Aviv. Thank you for the latest. Let's take a look now at some of the events we are following today. Other events, of course, on the agenda. 12 p.m. UK time, of course. We're going to have the Bank of England's rate decision, as we've been discussing. The central bank looks set to hold interest rates for a second straight meeting at 5.25%. At 12:30 p.m. UK time, it is US initial jobless claims. We were discussing with Mark there the mixed picture in terms of the jobs environment, at least in the US. That's followed by US durable goods orders. That's at 2 p.m. UK time. And finally, and very interestingly, Apple expected to release its quarterly results after the US market. There's going to be a focus, of course, in terms of the demand for the iPhone 15, particularly out of China. There's been some suggestion from some of their suppliers that maybe that demand has weakened in China. Mark, are you interested in the Apple earnings? How consequential could this be?
That lineup out of the US is massive. I've talked about initial jobless claims being important. Durable goods is really interesting because it's shown not very much sign of weakness, but companies are telling us a different story. And Apple earnings are massive. I'm afraid Bank of England's not the highlight today.
OK, so all about the earnings and the US data and a little bit of Bank of England. So coming up, we'll be live from the Barclays Asia Forum in Singapore. We'll be speaking to the former chairman and CEO of IBM. Artificial intelligence in focus. This is Bloomberg.
Welcome back to Markets Today. We're about 30 minutes from the cash equities open.
Here are your top stories. Holding steady, Asian stocks and futures climb after Jerome Powell hints the Fed may be finished with its most aggressive tightening cycle in 4 decades. Following the Fed, investors also expect the Bank of England to hold rates as evidence mounts that the UK economy, labour market and inflation are all weakening. Plus, Novo Nordisk profits top forecasts as sales of its obesity and diabetes drugs surge. We'll be speaking with the CFO and the CEO later today. Welcome back to the programme then. So lots to discuss this morning as ever. The earnings season increasingly in focus. The tech story no doubt affecting US market expectations. What about here in Europe then, Tom?
Well, that Fed-inspired relief rally continues and at least is being flagged by these European futures, particularly over in France. The CAC current, as you can see behind me, looking to gain about 0.8%. Here in the UK, the FTSE 100, it's pointing up by about 0.7%. And over in Germany, you're looking at gains of what? About 105 points at this point. Yes, the earnings story is there as well. Shell coming out, of course, with earnings essentially in line, but with a decent-sized buyback. And then, of course, you have Novo Nordisk on the drugs front. On the macro front, the data coming through, manufacturing from Spain and France, important as we look at the contours of that European economy, which is looking pretty soft at this point, isn't it? And, of course, we look ahead to the Bank of England meeting, the consequences for the UK, the consequences of the pound, and it is a hold that is expected, of course, from the central bank.
OK, so we focus on monetary policy after the Fed, before the Bank of England, also the weakness in the data out of the US. But, Mark, I know that also catching your eye this morning is some of the conversations on the earnings calls and the language being used, giving us a few macro signals.
Yeah, I thought this was a really kind of interesting chart brought up by our equities team. It was the mentions of weak demands on earnings call. Now, they have data going back to 2000. And this grey bar, we're about halfway through this earnings season, or just over halfway through. This grey estimate is where we'll end up if we keep at the current pace of this earnings season. So I should say it's not confirmed. But already last quarter was the worst for kind of weak demand in the earnings season that we'd seen in data going back to 2000. We now look like to surpass that again. And this is just another confirmation of that sign that we know the backward-looking earnings have been good. But company owners are getting increasingly worried about the outlook going forward. Now, I mentioned at the top of the show that a general theme of the last couple of years is that soft sentiment indicators have not been followed through with hard data. So maybe this will be another case that company owners have no idea of the future and they're also getting it all wrong. And maybe they're wrong to be so pessimistic and consumers will keep spending. But my A priority is I'm worried about the consumer already, so I'm paying attention to this and I am nervous about going into the fourth quarter of this year.
OK, from the macro and the US consumer to what is happening in the tech space now. The latest earnings from Intl and Samsung indicate that the worst may be over for chip makers, and the boom in cutting-edge AI tech is set to continue. However, attendees at the UK's AI summit have flagged the need for greater regulation of the nascent sector.
I'm convinced that AI will bring us the right solution for labor shortages in Germany, and this is why we need AI and we need to focus on the benefits of AI and handling the risks on an international coordinated regulatory framework.
OK, very pleased to say that right now joining us from the Barclays Asia Forum is Ginni Rometty, former IBM chairman, of course, and CEO. She's also the author of Good Power, Leading Positive Change in Our Lives, Work and World, which was published earlier this year. Ginni, thanks so much for joining us. And I want to start and draw on your deep experience with AI in terms of your time, of course, at IBM as chair and CEO. And the debate that came through yesterday, a clear sticking point, a clear point of tension when I was at the AI summit yesterday was where to put the focus in terms of regulations around the risks, the focus on the risks. Should they be on those existential issues that may be 1, 2, 3, 4 years down the line or further? Or should they be on the here and now, the misinformation, the questions around data and security and cybersecurity, the here and now issues? Where do you land on that debate, Ginni?
Well, I think it's a very not only important debate, but I think it's worth taking action now on today's issues, because so much of that's going to set the stage for the future. And if I learned anything from all my years with AI, is that it boils down to people having trust in this technology. So the biggest issues now around disinformation do need to be addressed, or the use of AI for things like people's financial decisions or health decisions. You really need to have firms be accountable for that AI and accountable for its usage in those contexts. So I would focus actually on both of these issues, but I think we've got to really deal with the upside and downside in parallel starting now.
OK, so we start now. Good morning to you, Ginny. Thinking more about the regulation here and perhaps some of the legal implications, that also another topic that comes up often when we discuss AI. You've said that companies need to think critically about the information that feeds their AI. Given your experience working with companies using AI in its earlier stages, what do we need to understand about what types of data companies should feel able to use and able to train their AI on?
Yeah, look, I think this is a key issue, that you use data that you have the most confidence in. And if you've got great confidence in that data, you're going to have confidence in the outcome. And in fact, that's where you'll see the winners in this area, is go to uses of it where you can have high confidence in the training data. Because actually the right kind of regulation ought to be regulation that is not of the technology itself, but of the usage of the technology in high-risk contexts, and then have accountability for that.
That's really interesting, because that's a really important distinction. There are those, of course, who say you need to regulate the models. It's the developers who need to be scrutinised, not just those building the products on top. So that's a really interesting line from you there, Ginny. I just want to play a soundbite from Inflection AI CEO, so someone who co-founded DeepMind, Google DeepMind, back in 2017. And his view is that you need a global body. And I just want to get your reaction to this soundbite. Let's take a listen to Inflection CEO on the need for a global body to oversee AI regulation.
I expect lots of governments to now seed their own AI safety initiatives. And I think one thing we really have to think about is how this network of initiatives comes together. And what I've proposed is an IPCC-style body called an International Panel on AI Safety to coordinate on the right standards for safety between all of these bodies. Just as we've had with climate change, a group of the really top scientists in the world try to establish consensus on what are we actually developing today, what capabilities do these AIs have, and what does the next 5 to 10 years look like? And that needs to be impartial.
So, Ginny, I'm curious, is that kind of global regulatory body realistic, given the divisions between, for example, just China and the US? Or do you need to be focused on a kind of agency level, federal agency level, or country by country regulatory framework? How do you view that question?
Yeah, I think, Tom, you used the right word. I don't think it's realistic. In all my decades of dealing with this, what you've got to have is some sort of harmonization, and that's really just going to happen with dialogue amongst all these different countries as they continue to try to coordinate. Just look at GDPR and the privacy rules. You've got GDPR in Europe, yet you have a bit of a patchwork still in the United States. Now, we're not going to see the same regulation come through, but some harmonization is needed. So I think coordination, harmonization, you see that already with cybersecurity amongst many of the like-minded countries that are out there. We'll have to do the same thing here. But it is just really important that all of the different countries take a perspective on this, communicate it, and then we try to, not only from a regulatory perspective, deal with it, but think about as a company that uses it. So everyone's got a role. Those that build the technology, those that use the technologies, the governments that govern its most sensitive uses. And so that, to me, is a job of coordination more than it is of a agency.
OK, and you mentioned that precision regulation then is the thing for you, and that's the focus. And you cited some European legislation around GDPR, for example. So that takes me to my next question about what we've learned from attempts to regulate or not regulate social media. And I know that's a little far away from the IBM business, but therefore maybe your thoughts more interesting than those who are closer to it. What have we learned from our attempts to regulate early uses of AI in social media, and what that tells us now, Ginny, about what to go to next?
Yeah, I think it tells you two important things. One is that what we learned with social media, we knew long ago that there were some downsides, but we worked on the upsides before we ever dealt with the downsides. So that tells you the first thing is to deal with this in parallel. We've got to work on celebrating all the great things it can do. I think AI can be one of the greatest equalizers for many people, but at the same time now deal with some of the greatest downsides, which start with things like disinformation. So do that now. That's one big learning out of that. The second big learning is I do think there has to be accountability for misuse. So when I say precision regulation, I mean, okay, pick the highest use cases when it's your financial future, when it's bias, when it's important healthcare decisions. And those will, with them, have some sort of accountability if those are right or wrong. And so we did not have neither of those things happen with social media, where we address the upsides and the downsides at the same time, and that we, for the highest risk use cases, also had accountability. Those are the two things I do different.
Ginni, you're in Asia, you're in Singapore, and of course you put the legwork in when you were CEO of IBM in terms of travelling the world and getting a feel for your business globally. What is your sense as to who wins this AI race ultimately? Is it China or is it the US?
Look, I think that's completely under control on who is going to, if you had a scale of innovation on one scale and perhaps on the other side protection, and another scale that had on one side control and on the other side adoption, whichever country kind of can land that closest to the innovation side along with adoption is, if without defining exactly what winner means, but who I think is the winner here. And so I think that's within the control of both countries here on how they look at their both regulatory environment and what they encourage. So is it entrepreneurs? Is it open licensing? Is it the use of these technologies broadly to be adopted, or just in the case of things like surveillance and other areas? So that's the way I think it's still could be determined. I think the U.S. and other countries have a great head start, but I think these technologies are moving fast, and it's more about how you look at this from an innovation and from an adoption perspective.
Very, very interesting indeed. Ginni Rometty, really appreciate your time for us this afternoon for you, this morning for us, of course, former IBM chairman and CEO. Thank you. Now to the bank space. Barclays reporting disappointing results last week, with the bank's trading division missing estimates and the firm lowering guidance for its UK business again. Bloomberg's Haslinda Amin spoke to CEO CS Venkatakrishnan about the results at the Barclays Asia Forum in Singapore.
I think we had a quarter that was difficult in one particular element, in net interest margin, which is an indication of peaking rates in the UK and the spreads which we make on it. Now, we were not very different from the other UK banks, but we heralded the trend for some of them. And I think there's a broader question which we spoke about at our earnings call, which is an investor on a day and announcement which we will do in early February, which will talk about what our shareholders should expect from us in terms of returns, in terms of the compositions of returns, in terms of how we are running our businesses, and how much we will share with them. And I'm really looking forward to doing that in February.
Talk to us about your strategy review as you head into it. I mean, what will be the areas of focus? Are there particular businesses that you'd like to zoom in on to drive that growth?
Yeah. So, in a way, you have to look at the bank, if you look at it over 15 years, and we've gone through, if you begin in 2015 or so, we had a period after the financial crisis when there was a lot of cleanup happening in Barclays. Legacy regulatory settlements, legacy issues like PPI in the UK, all of that, and the need to build up capital led to years of returns of single-digit ROTE, and this was in the 2015 to 19 stage, roughly speaking, single-digit ROTEs and capitalization building up in the bank. So the bank used to have a CET1 of around 10%. Now it's 14%. If we actually used the calculations of 5 years ago, that 14 would be more like 16. So we've been spending money investing in that and building it up. We've also been investing in our investment banking business, our markets and trading business. And then there was a period when there was a question, should Barclays be in investment banking? And if it was in investment banking, would it be any good at it? Well, we're the biggest investment bank outside of the top 5 domiciled in the US. So we are Britain's global investment bank. And so we've been successful. In the next phase, I think we've got an investment bank at scale, and we've got to focus on the businesses around it, which are generally higher ROTE, and tell our shareholders more clearly than we have in the past few years how much of the returns are going to accrue to them.
That was Barclays CEO CS Venkatakrishnan speaking to Haslinda Amin at the Lenders Asia Forum taking place in Singapore. Coming up on the programme, we'll get your stocks to watch, including, of course, Novo Nordisk, this European giant. Europe's most valuable company saw sales of its obesity and diabetes drugs surge. This is Bloomberg. Welcome back to Markets Today. 48 minutes past 7 here in London, and the futures picture looks positive. 12 minutes away from the start of equities trading. Looking into fact, the bounce we saw on Wall Street yesterday. Was it the Fed? Was it the weakness of the data? Certainly Fed expectations in the mix. Let's check in with the Markets Today blog. Sam Unstead joins us from the Markets Today team, can talk us through some of the stories that they are covering this morning. Let us go straight to the Bank of England, shall we, Sam? This is the event of the day, I suppose, for the UK calendar. Certainly expecting a hold. What are you watching for?
Very much expecting a hold. I think that's been almost completely priced in now. This is probably the least fraught Bank of England decision we've had for a while. So rather than looking, at the top line of the decision, it's going to be two things. Guidance, any kind of guidance really on how much longer, they see rates staying there, any kind of this Table Mountain idea, anything around that will be, I think, reacted to. And then the other thing is the split, the voting split, and just to see kind of within the policymakers what the thinking is on the rate path going forward.
Sam, I see that house prices in the UK are absolutely surging. Now give us the real story.
Well, Mark, I mean, there were gasps across the Markets Today desks yesterday when the Halifax data came through. I think it's worth going back to it again because the question really is whether this marks any kind of trend. And I think it's very unlikely that that's the case. So you have a very sort of heady supply-demand dynamic in UK housing. I think what you saw was that supply came down just a little bit faster than demand, and then that had this impact on these monthly house prices from Nationwide yesterday. So probably not a trend, but, not all doom and gloom. So, some positives to take from it.
All right, not all doom and gloom. I feel like you're running through the headlines of the Daily Mail, because we've got the house price story, and then we've got weather and Storm Ciarán. Why is this important for us?
I think this is always worth watching, not just because in the UK we are obviously obsessed with talking about the weather, but it does have an impact on the economy, and it depends, of course, on the size of the storm, the kind of impact that it ultimately has. But we've heard, from Sainsbury's this morning about the impact that weather has on clothing sales and merchandise sales, and we had Next yesterday, who actually created quite a nice little chart about how weather affects their...
That's helpful.
It is indeed, yeah, how weather affects their sales. So it's just something to keep in mind as we get to the retail sales data going forward.
OK, Sam, thank you very much indeed. With all things house prices, BOE and, of course, a weather check as well. You can get all of that and all the context, the details and the analysis from the Markets Today blog from Sam and the rest of the team. We might set up a live cam for those gasps of shock on the data when they come through as well. Just go to the website or type in TLIV Go on the terminal. Let's get to Joe Easton now from our equities team, the stocks to watch, and Shell in focus for you, Joe.
Morning, Tom. So the energy buyback bonanza continues with Shell announcing another $3 billion in share repurchases, making their total for the half year at $6.5 billion, well above what they said they would do at their last report. However, like BP, they are seeing their net income coming down slightly due to the weaker gas price. That seems to be the main driver there. However, what's interesting for me is that we can see from this chart here, even when the oil price as well as the gas price comes down, we're seeing Shell and BP staying elevated, suggesting that analysts and investors are really focused on these buybacks. So that should be taken well this morning.
OK, so that's the story around Shell. Apologies, Mark. Yeah, let's go to health stocks.
So health stock, we're going to go to Novo Nordisk first. Now, their sales surging 38% in the last quarter, driven by the diabetes and weight loss drugs. Wegovy sales were at 10 billion Danish kroner alone in the last quarter. That's more than $1.4 billion US. Now, we've also got a report out from Fresenius Medical that is missing analyst expectations today, the health tech firm. There is a connection between these companies that you may remember from a few weeks ago, with worries about Novo's drugs reducing the amount of necessary dialysis treatments, and that really hit Fresenius. So it's interesting to get both of those reports out today, but Novo looking really strong on those obesity drugs.
Joe, good morning. You're also looking at ING. What's the story there?
So ING, Mark, also doing a buyback today, around €2.5 billion. They've only just completed a previous buyback. However, their net income is missing expectations by about 2%. And analysts at BI saying that this is disappointing and will weigh on sentiment, according to them. ING has actually been a bit of an underperformer versus the broader sector. There's worried about the Dutch state potentially taxing those buybacks. So that's been hit and could, again, be mentioned in the analyst call later today.
OK, Joe, thanks very much. Our equities reporter Joe Easton with an update on some of the stocks in focus. Mark, we're moving into a session then that has the Bank of England, sure, but also has a lot of data out of the United States. I know you'll be really focused on that. But things looking pretty risk-on, whether that's driven by the Fed or the data and then the Fed. And that has an impact for plenty of global assets, including emerging markets.
Yeah, I think what's interesting to know is we've clearly got risk on today, and it's about yields lower and the dollar lower. And, rather than getting lost in a debate of how much it's Fed or bad data, whatever it is, the fact is, it is a markets-driven risk positivity. I think it's really important. We've not had strong data. We've not had exuberance here to drive this. So we're still in this era of bad data being good for risk assets. And I think the supercharged form of that at the moment is stocks in emerging markets, because they're getting both the EMFX gain and the equities gain. And so I think, emerging markets have been really disappointing this year. This was supposedly the year of emerging markets making a comeback. That has not worked. It's been the year of US stocks mainly until a couple of months ago. But it does seem that if we're going to be in a relief period, emerging markets can really outperform for as long as that relief period lasts. How long will it last? Maybe a week or two.
Just a week or two for EM. Softer dollar, lower yields. Good for that space, as you say. I just wonder if this is the pivotal moment, if this week will be marked down in the calendar as the moment when we solidified the pause and looked ahead to cuts. And if that pulls cash off the sidelines, Mark.
I think that Fed rates have peaked, but I don't think we'll know about that for another couple of months.
OK, Mark Cudmore, thank you very much indeed, leading our MLive team, walking us through the key market themes this Thursday morning. Thank you, Mark. The open is next, of course. European futures pointing to gains of 0.8%. The open is next. This is Bloomberg.
A few minutes to go until the start of cash equities trading. Welcome back to Markets Today. I'm Anna Edwards in London with Tom Mackenzie.
And here are your top stories. Holding steady. Asian stocks and futures climb after Jerome Powell hints the Fed may be finished with its most aggressive tightening cycle in 4 decades. Following the Fed, investors also expect the BOE to hold rates as evidence mounts that the UK economy, labour market and inflation are all weakening. Plus, Novo Nordisk profit tops forecasts as sales of its obesity and diabetes drugs surge. We speak to the CFO and CEO later today. So, Anna, there is a relief rally coming through. It looks like we're set for fourth straight day of gains, I should say, across European equities. The focus is on the central bank action, along with earnings.
Yeah, and a bit of data as well, as Mark was making the point last hour. Let's check across a number of assets then as we head towards the start of the European trading day. We've got positivity coming through from Asia, up by 1.4%. The earnings story is in the mix there, as well as what we've heard from the Fed and the weakness of the data and the response to that in markets. There is the earnings story, the likes of AMD and Qualcomm. That's helping some of the tech names over in Asia. S&P futures pointing higher then, up 0.25%. So this rally post-Fed, post-week data, that continues. US 10-year yield, 4.74%. We saw a 20 basis point drop in the yield at that tenor in yesterday's session as a result of, well, certainly post-Fed. And this is the Bloomberg dollar index. Worth pointing out that we are continuing to see dollar weakness this morning, down 0.3%. That also means a bit of strength in the pound. Does that leave the pound vulnerable with this Bank of England meeting looming large later today? Tom, what do you see on futures?
Futures then, you have the CAC looking to close up above 7,000 potentially. You're looking at gains of 0.8%. We'll see if they get through that 7,000 level. FTSE 100 looking to add 51 points. Over in Germany, upside of 0.7% being flagged by the futures.
OK, so expecting some positivity at the start of the European trading day. Then futures certainly suggesting that we catch up with Wall Street with a bit of that exuberance that entered into markets at the end of yesterday's trading day. As I say, the Fed talking about moving cautiously, carefully from here, and people drawing conclusions that in some cases are dovish as a result of that. Mark, though, focused in the last hour on the weakness of the data and saying actually it was that side of things that was driving sentiment. Anyway, all of that added up to a lower yield story in the US, and we see some of that very clearly coming through. Sovereign bond yields spent the last hour moving down, buying of sovereign bonds. We're also buying stocks then, that's very clear from the start of trade today. So we are pretty risk on. The FTSE in London is up by 0.7%, 0.9 on the CAC Caron, 0.8 over on the FTSE MIB. And we're kind of risk on FX as well. The dollar index continues to move lower. That's the Bloomberg dollar index down 0.3%. The euro and the pound both gaining as a result of that. A pretty pretty mixed picture then coming through on commodities this morning. What do you see, Tom, on the sectors?
Every major sector in positive territory. Technology, as you suggested, as a result of those lower yields, but also the good earnings and the forecasts coming through from chipmaker AMD. Technology surging at 1.3%. We've had higher iron ore and copper prices this morning. That is lifting basic resources. That sector currently getting 1.3%. And over on energy, because oil, Brent, CO1, that's the ticker. Brent and WTI both up this morning as well. So energy getting a lift, 0.9%. Those are the standout sectors as I see them. Every major index again, every major sector in the green. You're also looking at autos adding around 0.2%. But again, for me, it's technology, it's what's happening in basic resources and energy that really stand out in a positive mood for these markets. Across the benchmark, gains of 0.6%. Anna.
Yeah, what does it mean when you start to talk in tickers? Let's talk to Sam Unstead, who joins us from our Markets Today blog, who has plenty of tickers under review as a result of the Fed or the post-Fed market moves. Let's talk about the Fed then. We've dwelt on this a little last hour with some of our guests, talking about how they, given how far they've travelled at the Fed in terms of rate hikes, now being a little more careful with what they do from here. That seems to be one of the messages.
Yeah, it's interesting. So it seems to have been taken in quite a dovish way. But actually, as Mark kind of said earlier, it appears that a lot of the rally is really more being driven by the data. So we had that bad data yesterday. That appears to be, at the moment, good for stock markets. So although it's being taken relatively dovishly, it's hard to tell how much of it is the Fed moving everything and how much of it is the data. So that'll be something we'll have to, I suppose, dig into over the course of the...
Of course, that ties into what's happening in the bond markets. And it was pronounced yesterday, wasn't it? The 20 basis point move in the US benchmark, the 10-year yield. So the question then is that it? As the bear market for bonds closed, as the door closed on that, are you going to see more flows into US Treasuries to take advantage of those higher yields?
Yeah, well as you say, Tom, it's big moves, again, but that's becoming more and more common, or certainly much more common than when I started looking at, what Treasury yields are doing. And I think at the moment, it is very hard to tell whether the Fed is done, and it will become more and more a case of trying to decipher, is it the Fed, is it central banks that are moving Treasuries, or is it the data that's moving Treasuries? And in terms of, is this the end for where Treasury yields have gone? Certainly if you look at the chart, it doesn't indicate that. That still, yes, we've had a little bit of a dip, but that has happened previously. And so we'll just have to see really over the course of the next month.
And we've still got plenty of data to come today, as Mark was pointing out to us. We're focusing in on that. And interesting, that volatility in bond markets. We had a great big take story at the beginning of the week about hedge funds and fast money and the way they are much more active in bond markets than previously. So that's something to look into. Let me ask you about earnings, and we've got plenty here in Europe to talk about, but technology as a theme globally seems to be gaining momentum with AMD and Qualcomm.
Yeah, I think you guys mentioned AMD. I think Qualcomm adds to that story. Again, very similar to Intel and also what we heard from Samsung earlier in the week, an indication that the chip market is starting to turn and that a recovery is now seen. And of course, this also comes ahead of Apple earnings as well. And so I think that tech story will really start to get filled out. We had a lot of the big tech companies last week. Apple kind of rounds that out. And then we'll have a much clearer picture, really, of not just what's coming in for the final quarter of the year, but what's coming into 2024.
Yeah, we'll see if Apple builds on that positive picture and how much demand they're getting for that iPhone 15 and, of course, what the story is out of China as well. Sam Unstead, thank you very much indeed. Of course, from our Markets Today blog, you can get more from Sam, the rest of the brilliant team on the Bloomberg UK website, or by typing TLIV GO on the terminal. Coming up, the Bank of England is likely, as we've mentioned, to follow the Fed in holding rates later. The focus now turns to the forecast. We're going to discuss that next. This is Bloomberg.
This is Markets Today, 7 minutes into our European trading day, and European stocks are pointing higher higher this morning, up by around 0.8% on the stocks Europe 600. Let's check in with some of the individual movers this morning. Joe Easton from our equities team has an update for us. Joe.
I just one second, sorry. 1.1% at the moment. They did do another buyback, total buybacks in the half year, 6.5.
Oh, we seem to have a bit of an issue with Joe's microphone. We will try and rectify that. So stocks in Europe then, Tom, up by 0.8%. All sectors, I think, last time we checked in, were in positive territory. It's really that technology theme from Asia that seems to have captivated on the earnings side, and then the Fed/weak data story as well.
Yeah, so on the earnings story, we were discussing with Sam around the optimism, around the forecast that came from the chipmaker AMD. That led to some upside for technology stateside yesterday, and you also got a bit of lift in terms of the earnings that came through from Qualcomm. You pair that, of course, with the central central bank story, lower yields, that move of 20 basis points lower on the benchmark, and you get a good lift for technology. It's one of the top gainers across your sectors, 1.6% being added. Top of the list, though, is real estate, adding almost 2%. But every major sector so far in the session, what are we, 8 minutes in positive territory.
OK, let's get back to Joe Easton. Now, he does, I promise, have an update on some of the movers. Joe.
Keenly anticipated earnings this morning and movers. So we've got Shell ticking higher by around 0.7% now, coming down from the 1% earlier. They are doing another buyback. It is $6.5 billion worth of buybacks in the half year, above the $5 billion that they had anticipated. Meanwhile, BT coming up by around 3%. Earnings as well. They've got a new CEO coming in, and they are cutting costs with some job cuts as well. That one getting a bit of a boost today. In the fashion space, it's a mixed picture. Zalando is lower, a bit of a profit warning based on online retail. This is the German version of ASOS, coming down now. Was down around 3% earlier, actually, now down only 0.3%. Hugo Boss, strong sales, bucking the trend in luxury, doing pretty well in women's wear now as well. Earlier today, we spoke to the CFO of Hugo Boss.
We have exceeded our top-line performance and our bottom-line performance. The good news is really it's a broad-based growth, so we are growing for both brands, Boss and Hugo. Women's wear is even growing faster than Boss menswear, and we are growing in all our different regions. So all the investments that we have done and that we are still doing for Hugo Boss are really paying off.
So that was the Hugo Boss CFO speaking to Bloomberg, but we are, of course, also looking at Novo Nordisk as those massive Wegovy sales in the obesity and also general diabetes drugs. That one ticking higher, 1% following those sales. A decliner in healthcare is Haleon, the maker of vitamins that was spun out of GlaxoSmithKline. Weak earnings from them today. There's worries about Glaxo also selling down their stake in that company. Sainsbury's, that one moving up. The CEO was saying earlier that they are managing to fight off competition from the likes of Aldi and Lidl, so their earnings doing pretty well. And Intl, now this is an interesting one, the gambling company saying that favourable sports results are weighing on their earnings, so punters making more money from their bets is hurting them, according to Intl. So that one ticking lower at the moment. Doesn't really count for me betting on Chelsea, but I'll take his word for that one. We'll flip over onto the final board. We've got Tenaris. This is the steel piping company. That one a big gainer, up around 8%. And Lufthansa as well, gaining a bit of altitude. That one after some solid earnings. They're saying they're seeing a recovery in the long-haul market for Lufthansa. Howden Joinery, that is DIY and kitchens. That one getting hit in London following some weakness. And finally, ING actually lower. They did do a big buyback, but the net interest income is weakening a bit. Costs are also higher. Earlier today, we spoke to the CFO of ING, so let's have a listen now.
It's been a good quarter for us. We have generated strong revenue growth, 32% increase year on year. Our cost trajectory are beginning to come down as inflation comes off. Risk costs are doing well. All of that adds up to strong profits, strong capital generation. And that strong capital position allows us to do this share buyback of $2.5 billion. And that is really our second share buyback this year.
So that was the ING CFO speaking to Bloomberg. As I say, that stock down around 0.6% at the moment. It has been a bit of an underperformer over the past year, and that is continuing this morning.
Joe, you set yourself up for this. Chelsea,
well,
11th in the Premier League.
I should
Joe,
start.
how many points? 12 points. Arsenal
behind.
just need to focus. Arsenal number 2 in the league. They're going to catch up. They'll be top of the league after Tottenham. 24 points for Arsenal, 12 for Chelsea. Joe.
No chance. We're never going to recover from that. If we get 40 points, we'll stay up.
I'm glad you're being realistic, Joe. Joe Easton from Equity Team, thank you very much indeed. Let's stay in the UK then and focus on the Bank of England. The central bank action, of course, switching focus to the BOE, to Andrew Bailey and team. And Bloomberg Economics and every economist there expects a hold, of course, in terms of the rates at 5.25%. Let's get the context, the analysis with Bloomberg's UK correspondent Lizzie Burden. Lizzie, What are you going to be listening out for today? A done deal in terms of what they do with hikes seems to be the view, but we can get an update on forecasts.
Yeah, that's the view from markets and economists, but it could actually be a three-way split because you've got some very hawkish opinions on this committee and the very dovish Swati Dingler as well. She reckons only a quarter of the hikes so far have fed through, which is obviously less than the chief economist Hugh Pill reckons. He says it's about half of hikes so far. In terms of the guidance, we're expecting a copy and paste job here, that rates will stay sufficiently high for sufficiently restrictive for sufficiently long. So this Table Mountain idea that we're going to stay at this peak for a long time. If that's not forward guidance, if that's not a dot plot, I don't know what is, but that's another matter. So if we're not getting a hike today, it puts the forecast really on the forecast, as you say, and whether the Bank of England's going to reckon the UK economy is in for a recession, and therefore when the rate cuts are coming. Now, Andrew Bailey says it's premature to be talking about rate cuts, so echoing Christine Lagarde there. But what will be really interesting for markets is if you see the Bank of England expecting that inflation will fall below the 2% target at some stage. That would mean probably that investors would double down on their bets for rate cuts. It could spark a rally in gilt, and of course it wouldn't be good for the pound.
Lizzie, thanks very much. Lizzie Burden with an update on what to watch for from the Bank of England. We will bring you the Bank of England's rate decision live at 12 o'clock UK time, followed by Governor Andrew Bailey's news conference. That's at 12:30 p.m. UK time. Joining us with thoughts on the same subject, Rob Wood joins us, Chief UK Economist at Bank of America Merrill Lynch. Very nice to speak to you this morning. Robert, let's get into this conversation then, and a lot to focus on, as Lizzie said, even if we're not expecting a change in rates overall. But let's start with this issue of the vote split. So you're actually looking for something that looks like 7-2. Last time we saw 5-4, so it's pretty close. What's changed that makes you lean to 7-2 and not a three-way split, as Lizzie was mentioning?
Sure. So I think they're going to leave rates unchanged. I think that's absolutely nailed on. A lot of the data that they've had since their last meeting has either been in line with their forecasts or a little bit softer. Why would you shift to a slightly more dovish vote? I think it's just that growth looks a little bit weaker, unemployment a little bit higher than they expected. Two of the things that the people voting for hikes last time focused on was the resilience of consumer confidence and forward-looking indicators in the PMIs, which said it might not be great now, but things are going to improve. Both of those things have softened. We've also lost one of the hawks as well, who has left the committee to be replaced by Sarah Breeden. So I think that loses you one hawkish vote, and I think there's a risk that one of the others shifts to hold. Look, they've already held for a month now. The data haven't really strengthened since then. Are you going to restart now? I think just the bar to voting for another hike now is a bit higher.
Lizzie kind of nodded to this, that for some in the markets, the focus will now be on looking ahead to the next cut, or at least to when the BOE cuts. And you're saying, hold on, hold your horses. You're not seeing one in 2024. You don't see it happening until 2025. Why?
The UK, I think, has probably the biggest problem with persistent inflation among the developed market economies. We've got higher CPI inflation. We've got higher wage growth. I think there are signs that inflation expectations have been unsettled, modestly de-anchored. I don't want to say they're hugely de-anchored. I mean, it's not like the anchor is gone. But certainly I think consumers are much less certain about where inflation is heading. That's a problem for the Bank of England bringing inflation back to target. The economy, while it may be contracting very slightly in the third quarter, I mean, broadly speaking, it's stagnating here. Unemployment is very low. So I think they're going to have to hold rates in restrictive territory for some time here. Now, markets, of course, are going to look for when the cut is, because it seems the Bank of England is done with hikes. So the next direction is probably down. The question is when. I think it's going to be an extended time out till 2025. Markets are starting to look for the second half of 2024. I mean, not entirely unreasonable, but I think it'll be a bit later.
OK, so you think we don't get a cut until 2025, but you do think that the Bank of England is more tolerant of inflation than other central banks. What tells you that, other than the fact that inflation is higher right now?
I think that's what markets are telling us. So market inflation expectations are above target. They've been rising since 2016. It's 0.75% above target. You do surveys of people in the market. They say they see a big upside skew to UK inflation.
Out over what kind of time horizon? Is that all the way?
5-10 years. Right. And it's really unusual relative to other central banks. Now, I mean, it's a 0.5% upside skew. Again, keep it in context. But I think what markets are telling us is they've seen what the Bank of England's done over the last 18 months. They've seen data on inflation expectations and wage growth. And they think there's a risk that this will hang around, that inflation will be a bit harder to defeat than the Bank of England has in mind. That's why I'm looking for them to hold until 2025 rather than cutting maybe 6 months earlier as the market has.
You say you're also looking at the politics of the UK as well, looking ahead to the election. That, of course, may be called at some point in approximately the next 12 months or so. But you also say, interestingly, that you're looking for stimulus or potentially any nods or moves towards stimulus. Where would that come from? There's no room. The consensus seems to be that Labour, Conservatives, they don't have room to stimulate this economy. So why is that important for you?
Well, it's the interesting question, right? How do you ease policy when you've got no room against the rule? I think with an election coming up, with the polls where they are, you can see from the press over the past couple of weeks the pressure is going to be high to cut taxes ahead of that election. I think the fiscal rules and the fiscal outlook probably leave relatively little room for that. But what we've also seen when applying those fiscal rules is that the government is prepared to put in very, very tight spending plans that probably most observers think will be hard to deliver in order to manufacture room against this rule to ease taxes.
Do you think that's underpriced by the markets, a tax cut?
Yeah, I do. I mean, I think clients are beginning to come around to this. I think the focus is on whether policy will be eased. I think that does set the UK a little bit apart from some other countries, and I think it'll be a really crucial moment in this fight against inflation. If fiscal policy is eased in the spring, I don't think that helps much. Now, you're absolutely right. There isn't huge room against these fiscal rules. There's only so far you can really push these spending plans down. So we shouldn't expect a big bazooka here, but certainly some easing, I think, is likely. And I think that pushes in the wrong direction for inflation.
OK, Robert Wood, thank you very much indeed on the analysis, the views there around the trajectory for the UK economy. Maybe some stimulus coming through as we build up to that likely election. Chief UK economist at Bank of America, Merrill Lynch, and the views on the BOE as well. Thank you very much. Coming up, Novo Nordisk's earnings surge on hot demands for its diabetes and obesity drugs. We're going to break down the details of that story next. This is Bloomberg.
I think it's pretty clear that UBS is now a bigger and a much more formidable player in the European and in the global markets. As I said, we always had that scenario as a scenario that would be worthwhile pursuing. Again, I'm not going to talk about details because I haven't been around. I am occasionally called on by the Swiss government when they have an offsite, and so I'm in regular contact with the authorities there. But that's a confidential discussion that we have, and I wouldn't take that public. But I do think that UBS is now catapulted into a league of banks where, even more than in the past, it can actually be a good rival for the major US banks, both in the European and Asian markets in particular, but also on the US home market. And I think that is something that the bank has been preparing for many years. It's like with sports. You're never good if you don't prepare. And so it was well prepared. And I have all the confidence in the current leadership that they will excel and make this opportunity really a great future for the bank.
That was the former UBS chairman Axel Weber on the future of the Swiss bank. Let's turn to earnings stories this morning. And Novo Nordisk's third quarter revenue has surged 38%, beating estimates. That's thanks to bumper demand for its diabetes and weight loss drugs. Two of those, of course. Let's talk now to Bloomberg's Chloe Mele, who joins us this morning with analysis of what we've heard. Good morning to you, Chloe. So looking ahead, after the strong performance we've seen reported this morning, what should we expect from Novo Nordisk for the next few quarters?
Yeah, so by all accounts, Novo Nordisk is doing really well. It raised guidance last month. It had a really strong third quarter. Really looking ahead, the only sort of shadow or challenge is going to be supply constraints on Wegovy and Ozempic. It said this morning it was anticipating further periodic supply constraints there, and it was boosting capacity to help that. So given that demand really is showing no signs of abating either, that's going to be a key challenge going forward.
OK, so meeting that demand is a key challenge for the team at Novo Nordisk. What about the key catalysts that investors are going to be watching for then from now on in?
So another thing that they're looking for is insurance coverage of those drugs, and also the cardiovascular benefits of Wegovy. So there's going to be more detailed data coming through this month about that.
OK, and what about for other parts of the market? What about for demand for the food and beverage sector, for example? It seems in this earnings season this has been a much talked about theme. We've heard it from some of the big fast-moving consumer goods companies in the United States, for example.
Yes, so analysts and investors are anticipating the sort of knock-on effect that the growing popularity of what are essentially appetite-suppressing drugs are going to have on consumer staples, on food and drinks, on alcohol, etc. So that might drive some downgrades of some stocks, for example, in the alcohol sector, or fast food or something like that. So that's something that's going to be really a key focus as this gold rush around weight loss drugs continues.
Yeah, it's really fascinating to hear from the likes of Dunkin' Donuts and Krispy Kreme saying, hang on a second, this is going to impact demand for our sugar-rich donuts. All right, Chloe, thank you very much indeed on Novo Nordisk. The stock, by the way, up 2.3% on the back of those earnings. Chloe Melly there joining us with the context. We're going to be speaking to two top executives from Europe's most valuable company, Novo Nordisk, later. The CFO at 9:30 a.m. London time, and the CEO is just after 1 p.m. Stay with us. This is Bloomberg.
This is Markets Today, 30 minutes into your European trading day. Here are your top stories. Holding steady, European stocks and US futures climb after Jerome Powell hints the Fed may be finished with its most aggressive tightening cycle in 4 decades. Following the Fed, investors also expect the BOE to hold rates as evidence mounts that the UK economy, labour market and inflation are all weakening. Plus, Novo Nordisk gains after profit tops forecasts as sales of its obesity and diabetes drugs surge. We'll be speaking later today to the CFO and the CEO. So risk appetite, it seems, reignited, Tom, in these markets by maybe a dovish interpretation of the Fed, maybe the weakness in the manufacturing data. We saw that in the States yesterday, and we see it again in Spain today.
Yeah, the bad data is good news for these markets. The Spanish data, manufacturing PMI coming in, pretty ugly print, 45 around thereabouts for manufacturing PMI for the most recent month, below the 47 that it marked up the month prior to that. So just a reminder of the manufacturing squeeze that's happening not just in Spain, but across the Eurozone. But Spanish manufacturing now firmly in contractionary territory, and just a reminder of that with the print today. So the weak data arguably being seen as good news, and we're seeing that reaction across the bond markets as well. Very solid gains across these European equities now on the optimism, the Fed-fueled optimism. The earnings story is part of the mix as well, of course, and we can touch on that when we break down the sectors. Across the benchmark then, adding about 1.2% so far this Thursday. The DAX adding 166 points. Here in the UK, the FTSE 100 adding 1%, looking at 7,415 on the FTSE 100. Let's break down the sector story then, because basic resources is interesting. The energy story is interesting as well, given the results that came through from Shell, the estimates. The results, the earnings coming in line with the estimates, but the announcement of a $3.5 billion buyback, and then the optimism around Novo Nordisk as well, and its outlook for those obesity drugs. Travel and leisure up a full 1%. Auto's getting a really big lift as well, getting 1.5%. Lower yields as constructive for that sector. But look at the gains coming through for technology now. It's not just lower yields, but it's also the forecast, the outlook from the likes of AMD and Qualcomm as well. Don't forget, Apple earnings drop later today. The iPhone 15 demand story is going to be interesting, as in the China demand picture as well. But tech soaring, 2.3% is the gain coming through there. Consumer products up 2%. Basic resources now gaining 2% as well. So across these sectors, very solid gains so far this Thursday. The standouts, again, being technology, industrials, basic resources and the consumer. Again, across the benchmark, you're seeing gains of 1.2%. Anna.
That is really strong follow-through, isn't it, for European tech on those global tech themes, as you lay out. Also in focus, the energy sector this week. Shell shares gaining this morning. The oil and gas giant announced a $3.5 billion share buyback program. That's after it reported an adjusted profit for the third quarter of $6.22 billion, in line with estimates. Joining us now here on set, Bloomberg's Laura Hurst with analysis of what we've heard from Shell this morning. Laura, good morning to you. Run us through some of the highlights in these earnings then, as well as, crucially, how they did on gas trading, because that was such an area of weakness for BP.
Yeah, exactly. So quite a boring set of results in that it met expectations, but that's not a bad thing. And, for investors, they're happy because they've got 3.5 billion buybacks, which is more than they had guided on. They'd initially said 3 for the quarter. So that's a good thing for investors, and they're happy. Their returns are continuing at a solid pace.
Hang on, the buyback wasn't boring, was it? 3.5 billion? I mean, it's well above the BP number, 1.5 billion. So 2 billion above BP. There's also the idiosyncratic story, of course, around Shell. But what does that tell us about their ability to return cash to shareholders in the quarters ahead?
Yeah, this is something that really has turned around for the company. If we look back a couple of years ago, their return on average capital employed was like 3%, really paltry, and now it's well over double digits. They're piling money back to investors through dividends and buybacks, and it's at a higher rate than their peers, European peers at least. So that's exactly what sort of activist shareholders like Third Point were after.
Yeah, what can we expect from the quarters ahead then, Laura? An interesting theme within the wider sector, of course, has been M&A. We heard BP being quizzed on this. Of course, they've got an acting CEO, so possibly less likely they'll be involved in some of that, but saying that they don't need to. And this has been very much a US phenomenon, the likes of Exxon and Chevron. How does that and other things feed through into your expectations for the fourth quarter?
Yeah, well, that's something that I'm sure the management team will get asked in their earnings call with analysts later this afternoon. But so far, their peers have sort of rebuffed suggestions that they have to go down the same route. Eni, Italy's major oil company, yesterday, their CEO said, look, it's a different situation. In the States, they can do these all-share takeovers that we can't. So that gives them a big advantage, and we can do things organically. So I'm sure Sawan, the CEO of Shell, is going to have a similar approach.
OK, thanks so much for the update. Bloomberg's Laura Hurst. Despite the numbers just meeting expectations, finding some interesting lines to take us through on the Shell story. Let's get to some of the other top-read stories on the Bloomberg terminal this morning. Disney says it expects to pay at least $8.61 billion to buy Comcast's one-third stake in the Hulu streaming service. The statement marks the start of negotiations expected to last for months. The companies have previously said the final price will be settled through an appraisal process and is likely to involve up to 3 investment banks. A former Goldman Sachs investment banker has been sentenced to 3 years in prison after passing confidential deal information to his squash partner who traded on it. He was found guilty of insider trading and obstruction by a federal jury in June.
Bloomberg has learned that JPMorgan is searching for a potential partner to grow its private credit business. Our sources say the bank's in talks with sovereign wealth funds, pension funds and alternative asset managers. JPMorgan is looking for third-party capital to supplement more than $10 billion already set aside for its private credit push. And Qualcomm has given a better-than-expected revenue forecast for the current quarter, indicating that the mobile phone industry's inventory glut may finally be receding. We seem to say that a lot, don't we? The sales estimate from the largest seller of smartphone chips sent shares higher in late trading on hope that consumers are finally beginning to upgrade their phones again.
OK, coming up on the programme, will you be driving a Foxconn in a few years' time? The Taiwanese electronics giant is taking a gamble on the EV business. We'll talk about that next. This is Bloomberg.
Welcome back. This is Markets Today. Happy Thursday. You're seeing gains, very solid gains across European stocks of 1.2%. US futures also pointed to upside of 0.4% on the S&P E-minis. Let's get to what's happening then in the tech world, the auto world, and how the two are merging. With demand for smartphones remaining muted, Taiwanese iPhone maker Foxconn is looking to diversify. It's going into the business of making EVs. This is the company, of course, for which Apple would not exist without Foxconn and its ability to produce things like iPhones and iPads. Bloomberg's Reed Stevenson wrote today's Big Take story on the subject. Reed, why then is Foxconn getting into manufacturing electric vehicles, and why now?
Well, up until now, Foxconn has made laptops, servers, they make the Nintendo Switch, they make the Google Pixel, and the biggest chunk of that is indeed smartphones. But that market is saturating and slowing at the moment. And so with a new chairman and CEO in place ever since 2019, they've kind of identified new markets to get into. And one of the biggest, and the one that they think they can make a difference in, is electric vehicles. And that's why they're getting into this game.
OK, Reed, this question amuses me, even before I ask it. Just how different or similar is it to make a smartphone an electric vehicle? And as crazy as that question sounds, I do remember years ago talking to the Ford CEO, and this was before electric vehicles were such a big thing, but it was certainly as more and more tech was finding its way into our cars. And he was saying you'll have to think in the future of a car as a smartphone on wheels. So I suppose they've become more similar.
Yeah, so you can come at this argument from sort of two directions. One is, indeed, a smartphone has a battery and a bunch of chips and a circuit board, and so do EVs, along with wheels and a motor, et cetera, et cetera. And so it's just an order of magnitude, slight order of magnitude, maybe more complex to build an EV versus a smartphone. And then, of course, on the other side of the equation, an EV has much fewer parts than a car, fewer moving parts, and so this should be easy. But there are some key differences. For example, quality control needs to be very, very good. Also, one of the stories I heard while reporting on this article was that, if something's wrong with a smartphone, you can kind of pluck it off the production line, but you can't exactly do that with, a 3,000-pound vehicle. And so there are a lot of sort of just physical challenges involved with that. And, one of the analysts I spoke to made another really good point, which is that, you can always reboot an iPhone, but you can't reboot an EV going at 100 miles an hour.
Yeah, that would be a slightly concerning prospect, wouldn't it, Reed? What does this all lead to then? There's been a lot of speculation over the years about the Apple car, and God knows when that's going to happen. If that happens, we know they have a team focused on it. Is Foxconn the company that comes and builds the Apple car?
Well, I think, that is really the big question. If Apple has been working on a car reportedly for the better part of a decade, our latest reporting indicates that it could come by 2030. But I think one of the things to consider here is that, Foxconn needs to build expertise if it wants to win a contract like that. It's going to have to show that not only can it pull it off, but it can do it at scale and at volume and sort of deliver the same quality product that Apple expects when it places orders for iPhones.
OK, really, really interesting. Reed Stevenson on the Big Take of the day. Thank you very much indeed. And, of course, you can read that Big Take. Just go and type in NI Big Take on your terminal, or check out, of course, the website for the online version as well. Sticking with technology, Google DeepMind CEO says it is necessary to proceed with, quote, cautious optimism when considering artificial intelligence's future benefits. I spoke to Demis Hassabis at the UK's Global AI Safety Summit yesterday.
I think the message that we bring is one of cautious optimism. Obviously, we're working on this technology because we think it will be one of the most beneficial technologies to society ever. But it does come with attendant risks, as all transformative technologies do. And I think we need to take those seriously, ranging from the near-term risks to the longer-term technological risks. And I think we need to start an international dialogue about that now. So it's fantastic to see this happening, the summit.
And there is divergence from policymakers, but there's also divergence and quite passionate splits within your own community. You're very aware of this. The head of AI at Meta, Jan LeCun, saying, name-checking you, saying you're fear-mongering, there's maybe regulatory capture going on here. Your response to that critique, because Jan LeCun isn't alone, there are others who say, quote-unquote, it is preposterous to talk about some of these existential risks, fear-mongering. Is that what you're doing, Demis?
No, of course not. And there's equal luminaries on the other side of the camp as well, including some of Jan's fellow Turing Award winners. And we've all known each other for a long time, actually, from the academic community. So, and as far as sort of regulatory capture and other things, I think that's pretty preposterous. We've been, myself and Shane Legg, one of my other co-founders, founders of DeepMind, have been talking about AI safety since we were postdocs and academics in 2009, so before we'd even started our companies. So I think it comes from a genuine, actually, uncertainty around where the technology can go. It's enormously powerful. We know, and that's why we all work our whole lives on it, all of us. We think it can bring incredible benefits to science and medicine and climate, environment, and can actually help us and help society face some of our greatest challenges and solve some of those challenges. But in terms of where the technology is going to go and the capabilities it will have, there's a lot of uncertainty around that. And I think it's good there's disagreement, and even amongst the academic fraternity, and that just shows you that's why we have to proceed with cautious optimism. We want to make sure we get the benefits of the innovation and the promise that the technology clearly holds, but we've got to be do it in a responsible way, I would say, using a scientific method, trying to have as much foresight on the technology as possible, so we predict ahead of time what the unintended consequences might be.
I guess for some it's the emphasis, and the Deputy Prime Minister himself, speaking to us earlier, said this is very much this summit focused on frontier technology, so the next models that DeepMind and others may be coming out with in the next 12 months or so. Others would say, look, we need to focus on the more prosaic risks of the here and now, the misinformation, data security. Those issues are not being given enough weight, the critics would say.
Yeah, I don't agree with that. I mean, I think that actually even in the summit, there's many sessions on the near-term risks, and all of us in the Frontier Labs are also thinking a lot about near-term harms and how to mitigate those.
That was the Google DeepMind CEO, Dennis Hassabis, speaking, of course, to Tom just earlier this week. Let me just get to some breaking news across the Bloomberg terminal this morning. We're following the manufacturing story and the weakness of that globally. And now it's Italy's turn to feed into that theme. So 44.9 is the latest manufacturing PMI data that we have from Italy. This follows a weak print from Spain, a weak print we got from the United States yesterday. Our colleague Mark Cudmore telling us that this was actually part of the reason that we saw stocks rally yesterday, because it led to lower expectations for what the Fed does. So how is this feeding into the Eurozone ECB expectations? Well, the Euro's not moving much this morning. We might be seeing a little bit more movement on bond markets, or maybe that work was done after the weakness in the inflation prints we got in recent days. Coming up, we'll talk more about macro themes, but pivot to the Bank of England. It's likely to follow the Fed in holding rates steady later on today. The focus now turns to the forecast. We'll discuss that next. This is Bloomberg.
People are calling this the immaculate disinflation. We usually think you need a weak economy to pull the inflation down as rapidly as it's been falling.
Clearly what the market saw was a preference for the worry of tightening financial conditions. We're at sufficiently restrictive. We can be done.
The risk is that inflation is too stubborn. If I were recommending or talking to Jay Powell, I would recommend that he leave the door open to doing more.
Our concern is sort of around May and June, where is the Fed going to be? And I think the optionality to have rate hikes still on the table and that every meeting's live is really important.
If you've taken a break for, let's say, 6 months, and the evidence accumulates that monetary policy is not as tight as you think it is, and inflation expectations are starting to become unanchored, labor market's not loosening, wages are stuck at 4.5%, then it's unlikely that 1 quarter point move is just going to be sufficient to do the job. So I think it's either zero or multiple rate hikes.
OK, some of our guests there reacting to the latest Fed decision. When it comes to the ECB, the data, of course, added the Eurozone importance, and the line coming from France in terms of the latest manufacturing print for the month of October. PMI, manufacturing PMI coming in at 42.8 for France, just marginally above the pre-lean number. But this is the lowest print in terms of manufacturing PMI for France in at least 3 years. And it's worth noting that France and its manufacturing sector have not been in expansionary territory since January of this year. That's when you got a print of 50.5. So what a move from 50.5 back in January to 42.8 now for France. And a reminder just of the softness of course, the Eurozone's second largest economy. The euro dollar not moving a lot on the back of this. It's currently up 0.3%, largely on softer dollar, it seems. On the context, then, the analysis, let's bring in Bloomberg's chief European economist, Jamie Russ. Jamie, how has the data then evolved since the ECB's last meeting? Does this solidify the Dove's views that the ECB has done enough, given the weakness that we're now seeing across the Eurozone?
Yeah, I mean, I think it does. It certainly supports that narrative. I mean, I think the reason we're not seeing markets move in response to this data is because the ECB was pretty much guaranteed not to do anything anyway for the rest of this year. It seemed pretty clear to us that they'd signalled that the hiking cycle was at an end. So really, it's not going to change the ECB's policy decisions over the next few months. I mean, I think the big question is, when you look at manufacturing PMIs, you normally think that when you enter a recession, it's manufacturing that goes first, then services. So is this telling you that there's a deep recession coming? I think probably no, because there are some unique circumstances this time around. Global demand's falling off for manufacturing exports, for example, which mean that there isn't such a clear link, but still it's flagging some risk to the ECB.
We'll get the German data and see if the same applies there. We have had some weakness in that story, haven't we, Jamie? But let's go a bit more global then and think about the Fed and how that plays into the calculus at the Bank of England today. Expectations in markets are really for no change, but there could be other areas of interest.
Yeah, I mean, I think the markets have pretty much ruled out a hike. They had priced in about a 10% possibility before, going into the Fed meeting. So that has altered markets' perceptions of what the Bank of England is most likely to do. I think, central banks don't like to admit it, but they all look at the Fed, and that none of them operate in a vacuum. And so the Fed's decision and the signal that they are probably done hiking as well has an impact, both because there are legitimate reasons, because the currency, of course, is under less pressure if the Fed doesn't hike, so the Bank of England doesn't have to hike to match it. But there's also reputational management considerations as well. And again, they wouldn't admit it, but if there's a big recession coming, which there might be, would you want to be the last central bank still hiking? The answer is probably no. So I think it affects people's decision making in more ways than one. It's not just economics.
Jamie, when it comes to whether or not we look at a cut from the BOE as being the next move after today. We were speaking to Rob Wood at Bank of America Merrill Lynch. He doesn't see cuts coming through until maybe early 2025. He doesn't see them coming through next year. Does that align with your view?
It doesn't. I've got a lot of time for Rob, but I think it seems likely to us that inflationary pressure is going to ease off sooner than that, and that will open the door to rate cuts probably from the middle of next year. And if you get a big slowdown in the economy that people aren't really forecasting right now, but if that were to happen, that would bring that timeline even sooner. And of course, it will depend a lot on what other central banks are doing, as we just discussed. So if the Fed starts cutting in the middle of next year, is the Bank of England going to wait another 6 months? I would guess probably no. So we'll see. You have to keep an eye on the data on both sides of the Atlantic to get a feel for what's going to happen, I think.
OK, Jamie, thanks very much. Bloomberg's chief European economist, Jamie Rush, joining us there with analysis on the European story. And just to complete the European story, we've got German manufacturing PMI coming in almost in line with estimates, actually a touch stronger, but at such a weak reading, 40.8. So maybe a relief to some that we're not dropping down into that 30 handle again, but 40.8 against an estimate and a prior of 40.7. On the subject of the Bank of England, which we were hearing about there from Jamie, we'll bring you that Bank of England rate decision live at 12 o'clock UK time. That's followed by the Governor Andrew Bailey's news conference at 12:30 p.m. UK time. We'll be speaking to Bank of England Governor Andrew Bailey. That interview at 4 p.m. UK time. A lot of focus on the detail, on the vote split there, of course. Meanwhile, stocks are strong.
Stocks are strong, and part of that is down to the central bank story. Part of that is down to what's happening in the gilt markets here in the UK, with yields coming in sharply, around 8 basis points at the front end. Similar picture on the 10-year as well. And that is seemingly playing into what's happening in the real estate sector as across your sectors in Europe. Storming gains of 4% across the real estate sector of Europe. Every sector is in the positive territory. And across your European benchmark, gains of 1.4%. Here in the UK, you're adding 88 points. There's a stronger performance, though, coming through for France. The CAC 40 is up 107 points above 7,000. US futures pointed to gains as well. S&P E-minis up 0.5% on Fed-fueled optimism. Plenty more coming up. This is Bloomberg.